Okay, this is what we were talking about before we went to break. Food. The cost to feed families is so high that more Americans are taking out short-term loans just to buy their groceries.
While buy now, pay later loans have been in use for big ticket items for years.
You can see the impact of inflation most clearly these days.
Americans once financed houses and cars. Today, some are financing groceries. How did we get here? This is Fiscal Forge. For most of modern history, borrowing money for groceries would have sounded insane. People financed homes, cars, businesses, not bread, not milk, not eggs. But today, millions of Americans are now using credit cards, buy now, pay later apps, payday loans, paycheck advances, just to afford basic food.
While buy now, pay later loans have been in use for big ticket items for years, new data is showing that a growing number of American consumers are using the payment method for everyday items. A recent survey from LendingTree finds that a quarter of consumers are using these payment plans for groceries. That is up 14% from just a year ago. A survey found groceries to be the fourth most common buy now, pay later purchase among Gen Zers, trailing behind clothing, technology, and home decor.
And that raises a disturbing question. What happens to a country when ordinary people can no longer afford necessities with their own income? Because this isn't just about inflation anymore. It's about something much bigger. The slow transformation of survival itself into debt.
U.S. consumer confidence fell for the fifth straight month, hitting its lowest level since May of 2020. And this comes as a new LendingTree survey shows some pretty eye-opening numbers. Look at this. 25% of Americans who have buy now, pay later loans are using them to help afford groceries, and that number is up from 14%. You're also looking at another number on your screen. 41% of those customers admit to making a late payment on a loan in the past year. That number is up from 34% the year prior.
Over the last few years, food prices across America surged dramatically. Eggs, meat, fast food, groceries. Almost everything became more expensive. At the same time, many salaries failed to keep up, and now an increasing number of households are turning to borrowed money just to make it through the month. But the most disturbing part is this. Many experts believe this trend may not disappear anytime soon, because underneath rising grocery bills, there's a much deeper economic problem quietly reshaping the middle class. And if this continues, the next decade of consumer finance could look very different from the world Americans once knew.
Also a reason for alarm, more Americans using these buy now, pay later loans, which can often carry interest. What do you make of that?
Yeah, this is becoming increasingly popular. This is basically where you are at the cash register and they offer you the chance to buy now and pay later, exactly what it says. And so, that started with some big ticket purchases, and that wasn't dissimilar to maybe taking a loan on your credit card, but now it's spread into other things. So for example, just a few weeks ago, DoorDash added buy now, pay later, so you can actually buy now, pay later for your takeout, for your delivery. And so it's getting into other aspects of life, and when people are putting off purchases, it adds to this quote-unquote hidden debt, which could ultimately create a more stressed consumer.
To understand why people are financing groceries, we first need to understand what happened to prices. During the pandemic, global supply chains broke down, factories slowed, shipping costs exploded, energy prices surged. Then inflation spread across nearly every sector of the economy.
On their day-to-day life. I want to ask you about the Organization for Economic Cooperation and Development. It has downgraded its economic growth outlook for the United States both this year and next year. How significant is that move, and what does it mean?
So it's fairly significant. We are down from 2.8% in 2024 to now what we're expecting to be 1.6%. Still positive, right? We did see first quarter negative GDP. So I think overall this is good that we're expecting at least some growth. That being said, it keeps getting revised down. And to your point, this is all because of tariffs, potential higher inflation, and just that larger uncertainty that maybe people go and spend less and the economy contracts some. Doesn't mean that these surveys are always right, but it's certainly a warning sign.
Food inflation became especially painful because groceries are unavoidable expenses. People can delay buying a car, but they can't delay eating.
The price of a dozen eggs up 158% in the past 5 years. A pound of ground beef up 52% over the same time frame. And perhaps most painfully for me, coffee up nearly 104%. New data released today by the Bureau of Labor Statistics shows inflation is still up, but price increases are slowing overall.
According to data from the U.S. Bureau of Labor Statistics, food prices experienced some of the fastest increases seen in decades. And when inflation rises faster than wages, purchasing power collapses. That means even people earning decent salaries start feeling poorer. Real income equals inflation rate, nominal income. This blow worked today. This is one of the biggest reasons many middle-class households suddenly feel financially trapped. Not because they stopped working, but because money itself buys less than before. And once necessities become difficult to afford, debt starts replacing income.
I think it is, absolutely. I think when you see people putting more and more bills on the credit card, that's concerning because it does suggest that they don't necessarily have the cash flow to pay for it up front. Now, we would expect credit card debt to go up over time as inflation continues to cost things that cost more, and incomes continue to go up. But if it's going up at a pace, as it is, that exceeds those things, then that can be really concerning.
For years, Buy Now, Pay Later services focused mostly on fashion, electronics, luxury spending. But recently, financial companies discovered something much bigger: necessities. Groceries became one of the fastest growing categories for short-term consumer borrowing. And psychologically, that changes everything.
LendingTree survey found that a quarter of BNPL customers have used them to buy groceries, up from 14% in 2024.
Financing a television feels optional. Financing food feels desperate. That's why economists and financial analysts are paying attention. Because historically, when large numbers of people begin borrowing for necessities, it often signals rising financial stress beneath the economy. Some households now split grocery bills into multiple payments. Others rely heavily on credit cards just to survive until payday. And many consumers are stacking multiple forms of debt simultaneously.
So the hidden debt seems to be getting bigger, and so is actual debt. According to the Federal Reserve Bank of New York, Americans have a total credit card balance of $1.2 trillion. Effectively, it's the highest balance since the New York Fed began tracking this way back in 1999. Is this another data point making your overall point that people are stretched and stressed?
Credit cards, BNPL, personal loans, paycheck advance apps, all to maintain basic living standard. The problem is, small recurring debt creates a dangerous cycle. A person borrows for groceries this month, then repays it using next month's income, which leaves less money available for future expenses. That pushes them back into debt again. And slowly, temporary survival spending becomes permanent financial dependency.
Inflation has steadily cooled over the past 2 years, despite seeing a slight stall in October and November of 2024. Prices for items like gasoline, used cars, and energy have declined accordingly. But food prices continue to outpace inflation, increasing by 28% since 2019.
But the real danger here isn't just economic, it's psychological. Financial stress changes human behavior. Studies in behavioral economics show that scarcity affects decision-making itself. When people constantly worry about bills, their mental bandwidth shrinks. Long-term planning becomes harder. Impulse decisions increase. Stress rises. And modern financial systems are designed around this behavior. Apps encourage instant spending. Notifications trigger urgency. Micropayments reduce emotional pain. The result? Consumers stop thinking about total cost and focus only on surviving the current week. That's exactly why financing groceries becomes normalized. Not because people think it's smart, but because survival pressure changes financial behavior, and for millions of households, that pressure is becoming constant. Whenever debt rises, someone profits. Banks profit from interest. Credit card companies profit from revolving balances. Fintech companies profit from transaction fees and consumer dependency. And even retailers benefit when consumers continue spending despite financial stress. Because debt allows consumption to continue artificially. That keeps the economy moving temporarily. But there's a hidden cost. As more income goes toward debt repayment, less money remains for savings, investing, emergencies, home ownership. That weakens long-term financial stability. And over time, entire generations can become trapped in permanent financial fragility. This is one reason many younger adults today feel financially exhausted despite working full-time jobs. The system rewards consumption immediately, but punishes debt slowly.
But broadly, LendingTree found that 41% of BNPL users paid late in the past year, up from 34% a year before. Affirm has reported a decrease in customer defaults.
We're delivering really good credit outcomes with our approach, which is to underwrite every transaction and to make an honest assessment at the point of sale.
And Afterpay says it has seen strong repayment numbers, especially compared to credit cards.
For decades, the middle class represented stability, a steady job once provided, housing, savings, food security, upward mobility. But many households now face rising costs in nearly every category. Rent, healthcare, education, insurance, groceries. Meanwhile, wage growth often struggles to keep pace with real living costs. That creates a dangerous psychological effect. People still earn salaries, but their lifestyle feels increasingly unaffordable. And when people feel financially cornered, they begin using debt to preserve normalcy. Not luxury, normal life. That's what makes this trend so important. Because financing groceries is not just a spending problem, it's becoming a symptom of a deeper affordability crisis. If this trend continues for years, the long-term consequences could be massive. Higher household debt, lower savings, delayed retirement, reduced home ownership, financial burnout, and perhaps most importantly, a generation increasingly dependent on borrowing for basic survival. Because once debt becomes normalized for necessities, financial resilience becomes much harder to rebuild. And that creates enormous vulnerability during recessions or economic shocks. But despite how dark this trend appears, there's still an important lesson hidden underneath it. Modern financial systems are designed to encourage consumption. That means financial survival increasingly depends on awareness. Not just income, understanding, budgeting, impulse control, debt management, emergency savings, financial psychology may become some of the most valuable skills of the next decade. Because while inflation affects everyone, financial habits still shape long-term outcomes. And the people who learn how debt systems operate early often avoid becoming trapped by them later. The truth is, most financial crises don't begin with one giant mistake. They begin with small survival decisions, repeated over and over again. And in a world where even groceries are becoming debt financed, understanding money may no longer be optional. It may become necessary for survival itself. If you enjoy this breakdown, subscribe to Finance Decoded. Because the global economy is changing faster than most people realize. And understanding those changes early could save you years of financial stress.